Do you know that successful traders in the market don't just stop at choosing the right trade? The real secret to success lies in understanding your trading system, controlling your psychology, and exiting at the right time. In this video, we bring you the complete summary of all 11 chapters of Van K. Tharp's best-selling book, Trade Your Way to Financial Freedom. You will learn how to achieve consistent profits and financial freedom in your trading career by adopting a systematic, psychologically strong, and strategic approach. So if you want every trade of yours to lead towards success, make sure to watch this video till the end. Chapter 1. The Holy Grail Myth. In this chapter, Van K. Tharp presents a unique perspective to lay the foundation for trading and financial freedom. He says that trading is not just a game of technical knowledge or understanding market movements. The real success lies in the trader's psychology and approach. The chapter begins with a story, which he calls the Holy Grail Myth. This story teaches us how small decisions and habits can transform into big results. Just like a grain of sand can be a part of a huge structure, our trading decisions gradually shape our financial life. Tharp explains that most people lose in the market because they fail to understand risk, probability, and psychological influences. Many traders focus only on technical charts and indicators, while their own fears, greed, and biases control their decisions. The most important message in this chapter is that the first step to becoming a successful trader is understanding your own mental and emotional model. You need to know how your decision-making process, thinking patterns, and habits affect your success or failure in the market. Tharp emphasizes one special point. Trust in your system and self-control is the real power. Without mental preparation and the right mindset, no technique or strategy can give you long-term profits. At the end of the chapter, he challenges us. Can you identify the mental and emotional reasons behind your trading decisions so that you can control your market experience? This question prepares us for the next chapter, where Tharp will discuss cognitive biases and why gaining control over the market is so difficult. Chapter 2. Cognitive biases, why most people find it so hard to control the market. In this chapter, Van K. Tharp explains that most traders fail in the market because their decisions are influenced by biases and mental traps. We often think that trading is just about technical knowledge or reading charts, but the real challenge lies in our psychological preparation and decision-making process. Key points of this chapter. 1. Biases and decision-making. Every person has certain biases, such as confirmation bias, where we only look for information that supports our beliefs. Doing this in the market leads us to ignore warning signals and suffer losses. 2. Overconfidence. Many traders have excessive confidence in their abilities. They believe they fully understand the market, but markets are always uncertain, and overconfidence often results in heavy losses. 3. Fear and greed. Every market decision contains fear and greed. Fear stops us from taking timely action, while greed pushes us to take excessive risks. Tharp says that recognizing and controlling these is the real strength of a successful trader. 4. Mental traps and emotional pressure. Traders often fall into mental traps due to fear of losing or desire for small, quick profits. Tharp explains that without a structured system and clear rules, we cannot escape these traps. Important message. The first step to gaining control over the market is recognizing your mental and emotional biases. Not technical knowledge, but your decision-making process and mental preparation decide your success. At the end of the chapter, Tharp asks a vital question. Can you identify the fear, greed, and biases hidden in your decisions so that you can work in the market with discipline and control? This sets the stage for the next chapter, where we will learn why defining our purpose and goals is essential and how it affects trading. Chapter 3. Setting your objectives. In this chapter, Van K. Tharp explains that the most important step for successful trading is defining clear and personal objectives. No trader can succeed in the long run with only technical knowledge or the ability to read charts. The core reason is that without clear objectives, your decisions often become unstructured, emotional, and inconsistent. Key points of this chapter. 1. Importance of personal objectives. Your objectives influence your risk tolerance, time management, and mental endurance. Defining objectives helps you design your trading system and strategy in alignment with your life and financial goals. 2. Profit versus life purpose. Tharp says that trading only for profit may lead you in the wrong direction. The correct approach is to consider trading as a tool to achieve your personal life goals and financial freedom. 3. Setting clear goals. Write down your objectives and make them measurable, realistic, and time-bound. Example: I want to earn a safe 20% return on my capital within the next 12 months without taking excessive risks. 4. Personal values and risk profile. Every trader has a different risk capacity. Set your risk tolerance according to your objectives so that you avoid emotional decisions driven by fear and greed. 5. Self-assessment and self-awareness. Understanding your psychological strengths and weaknesses is crucial for determining your objectives. This process helps you build discipline and confidence. Important message. No trader can succeed long-term without clear objectives. Setting objectives helps you make systematic and controlled trading decisions. Your objectives must match your risk, time, and mental resources. Tharp concludes the chapter with a question. Are your trading objectives aligned with your personal life and financial goals, or are you blindly chasing profit? This question builds curiosity for the next chapter, where we will learn how to develop an effective trading system. Chapter 4. Steps to developing a system. In this chapter, Van K. Tharp explains that a well-thought-out, clear, and personal system is absolutely essential for success in trading. No trader can earn consistent long-term profits through only experience or market knowledge. Key points of this chapter. 1. Need for a system. Trading without a system is like making blind decisions. A good system must match your goals, risk profile, and mental capacity. 2. Steps to develop a system. Tharp divides this into several steps. Step 1. Clarify your objectives and priorities. Your system must align with your goals, time, and risk tolerance. Step 2. Define strategy and rules. Decide what type of trades you will take, what signals you'll follow, and when you will enter/exit. Step 3. Risk management. Every trade must have controlled risk to avoid major losses. Step 4. Testing and discipline. Test your system using historical data. Maintain discipline in real trading, without letting emotions interfere. 3. Benefits of a system. A good system protects you from emotional decisions, greed, and fear. It ensures stable profits and risk management over the long run. 4. System must be personal. Tharp strongly emphasizes that you should never copy someone else's system. Your system must match your mental, financial, and time capacities. Important message. The secret of trading success lies in a personal and well-designed system. No strategy can give long-term returns without a proper system. At the end of the chapter, Tharp asks, is your trading system designed according to your objectives, risk tolerance, and mental discipline, or are you just copying the market? This leads into the next chapter, where we will learn how to choose an effective concept that actually works. Chapter 5. Selecting a concept that works. In this chapter, Van K. Tharp explains that the most crucial part of successful trading is choosing the right concept or strategy. This concept becomes the foundation of your trading system. Only the right concept can ensure long-term stable profits and proper risk control. Key points of this chapter. 1. Why concept is important. A concept works only when it aligns with your personal, mental, and financial profile. A wrong concept can make even good discipline and risk management fail. 2. Qualities of a good concept. Simple and clear. Avoid overly complex signals. Personally suitable. Fits your mental capacity, time, and risk tolerance. Testable. Using historical data. Balanced between profit and risk, aligned with your capital and goals. 3. Types of concepts. Tharp gives examples like trend following, counter trend, value-based, signal-based, technical signals. 4. Testing the concept. Before adopting any concept, test it using past data and simulations. This helps determine if the concept will be profitable for you in the long run. 5. Choosing the concept. Select a concept according to your personal style and experience. The right concept makes discipline and risk management easier. Important message. The right concept is the foundation of your trading system. Without the right concept, no system can deliver stable long-term profits. At the end of the chapter, Tharp asks, is your trading concept aligned with your mental capacity, risk tolerance, and goals, or are you simply copying another successful trader? This question builds anticipation for the next chapter, where we will learn the role of psychology and beliefs in trading performance. Chapter 6. Understanding. The importance of trading psychology and risk management. In this chapter, Van K. Tharp explains that successful trading is not limited to strategies or indicators. For real success, it is crucial for a trader to understand their psychology, risk management, and personal behavior. Key points of this chapter. 1. Importance of psychology in trading. Emotions like fear, greed, and ego often lead to wrong decisions in trading. Recognizing your mental patterns and controlling them is the key to success. Relying only on technical indicators is not enough. Psychology is what keeps a trader disciplined. 2. Risk management. Tharp explains that the most important skill for a trader is the protection of capital. Stop loss, portfolio diversification, and determining risk per trade are the main techniques. Trading only for making profits can increase risk. 3. Evaluating personal behavior. Each trader has a different level of mental tolerance. One person's strategy may not benefit another. Adopt a trading style that matches your mental capacity, time, and capital. 4. Qualities of successful traders. Disciplined and patient. Follow their rules. Do not make decisions driven by emotions. Always keep learning and improving. 5. Balance of mind and capital. Winning in trading is not just about making money. Real victory happens when you balance psychological control and capital protection. This balance guarantees stable profits in the long term. Important message: the key to trading success is not just technique, but your psychological understanding and risk management. Understanding your psychology and behavior is essential for every trader. At the end of the chapter, Tharp leaves this question: have you ever thought about how your emotions affect your trading decisions, and can you control them? This question increases curiosity for the next chapter, where we will learn how psychology and beliefs play a role in trading performance. Chapter 7. The role of psychology and beliefs in trading performance. In this chapter, Van K. Tharp explains that a trader's psychology and beliefs directly affect his trading performance. No matter how great your strategy is, if your mental state isn't strong, success will be temporary and unstable. Key points of this chapter. 1. Personal beliefs in trading. Every trader has a set of beliefs based on their experience and learning. These beliefs determine how much risk you take, when you enter, and when you exit a trade. If your belief system doesn't align with your strategic decisions, it can lead to confusion and losses. 2. Control of emotions. Fear and greed are the most common emotions affecting trading. Tharp explains that fear causes early exit, while greed causes excessive risk to increase profits. Successful traders recognize and control their emotional reactions. 3. Positive mental approach. Self-talk and mental attitude are important. A positive mindset brings clarity to decisions and boosts confidence. Seeing mistakes as learning opportunities strengthens mental resilience. 4. Commitment to trading rules. Following rules and maintaining discipline is the key to success. Traders who don't follow rules often fall prey to emotions. Tharp states that mental commitment and discipline always improve strategy performance. 5. Psychological techniques. Training yourself, regular self-assessment, and reviewing your emotions. Keeping a trading journal and reviewing every decision. Identifying and overcoming mental blocks and limitations. Important message: the core mantra of winning in trading is the balance between mind and beliefs. More important than technical knowledge and indicators is understanding and controlling your mental behavior. At the end of the chapter, Tharp leaves this question: have you ever thought about how much your personal beliefs and mental state affect your every trade? This question builds curiosity for the next chapter, where we will learn how to use setups and entry techniques within your system. Chapter 8. Using setups and entry techniques within your system. In this chapter, Van K. Tharp explains that having a strategy is not enough to become a successful trader. It is also crucial to use proper setups and enter at the right time within that strategy. Key points of this chapter. 1. Importance of setups. The success of every trade in a trading system depends on its setup. A setup is the situation in which the market is most favorable for you. To choose the right setup, you must understand technical indicators, chart patterns, and market behavior. 2. Entry techniques. It's not just about entering at the right time, but also applying the correct entry technique. Examples: breakout entry, when price crosses a key level. Pullback entry, when price returns from support or resistance. The right entry technique reduces risk and increases profit potential. 3. Mental preparation. Mental state is important while using setups and entry techniques. Fear or greed can cause delay or haste in entering a trade, resulting in losses. Tharp suggests that a trader must be mentally prepared before every entry. 4. Testing and improving the system. Regularly test setups and entry techniques within your system. Backtesting and paper trading reveal which setup is most effective. Make timely improvements and adapt techniques according to market conditions. 5. Risk management and entry. Always combine proper risk management with setups and entry. Decide your stop loss in every trade and never violate it. Correct entry technique helps in controlling risk. Important message: having a strategy alone is not enough. Accurate setups and proper entry techniques bring consistent success in trading. A mix of mental preparation, discipline, and technical understanding helps you make the right decisions within your system. At the end of the chapter, Tharp leaves this question: do you know when and how your trading system is most profitable for you? This question builds curiosity for the next chapter, where we will learn how to enter the market and why entry is not important. Chapter 9. How to enter the market and why entry isn't important. In this chapter, Van K. Tharp explains that for a successful trader, entry is just the beginning, but not the most important factor. Key points of this chapter. 1. Common misunderstanding about entry. Many traders think that entering the market at the right time is the key to success. But according to Tharp, compared to the right entry, the overall system and risk management are far more important. 2. Entry versus risk management. Even a good entry is meaningless unless you control your risk. Tools like stop loss and position sizing reduce risk in trading. 3. Importance of the system. Your strategy and system determine how many trades you will win, not just the entry. The system ensures that every trade is executed according to rules and discipline. 4. Avoid excessive focus on entry. Beginners often get stuck thinking, when will the right moment come? Tharp says excessive focus on entry affects your ability to make sound decisions. 5. Mindset of a successful trader. Successful traders focus on outcomes and their system, not just entry. They understand that the market is uncertain, and not all trades will be profitable. Main goal: trade consistently and with discipline according to the system. Important message: entry is important, but the real secret to success lies in your system and risk management. Without the right mindset and discipline, simply entering at the right time does not make a trade profitable. At the end of the chapter, Tharp leaves this question: have you ever thought about how much loss a trade can cause without proper risk management? This question builds curiosity for the next chapter, where we will learn how to protect capital using effective stop-loss. Chapter 10. Protecting capital with effective stop-loss. In this chapter, Van K. Tharp explains that for a successful trader, the most important thing is capital protection, and the main tool for ensuring this is stop-loss. Key points of this chapter. 1. What is stop-loss and why is it important? A stop-loss is a predefined level where the trade is closed to limit losses. Tharp says every trade carries potential loss, but stop-loss helps you control it. 2. How to set stop-loss. While deciding stop-loss, consider the system and market conditions. It should not be based only on technical levels, but also on your capital and risk tolerance. 3. Position sizing. Along with stop-loss, it is essential to decide how much money to allocate to each trade. Smaller position sizes limit losses and reduce the risk of major damage. 4. Controlling emotions. Following stop-loss is difficult for many traders due to emotions like greed and fear. Tharp says discipline and mental preparation are necessary to apply stop-loss without delay. 5. Using stop-loss for profitable trades. Stop-loss doesn't just protect from loss, it helps run trades according to the system. Properly set stop-loss increases long-term profits. Important message: without stop-loss, any trader is putting their capital at risk. Correct stop-loss and position sizing together make trading safe and profitable. At the end of the chapter, Tharp leaves this question: have you ever thought how long and safe your trading career could be if you could limit your losses? This question builds curiosity for the next chapter, where we will learn strategies for taking profits and exiting trades in the best way. Chapter 11. Strategies for taking profits and the best way to exit trades. In this final chapter, Van K. Tharp explains in detail how to secure profits in trading and exit at the right time. He says that exiting a trade is even more important than entry. Key points of this chapter. 1. Importance of taking profits. Many traders hold positions too long in hopes of bigger profits, which can increase losses. Tharp says taking profit at the right time and exiting a trade is the key to trading success. 2. Using trailing stop. A trailing stop helps secure profits and adjusts your trade automatically according to market movement. It is a flexible form of stop-loss that locks in profit and protects you from sudden market drops. 3. Use mixed strategies. Relying on only one strategy for profit-taking is not enough. Tharp suggests adopting mixed strategies based on system rules, market conditions, and personal risk tolerance. 4. Emotional control. Greed and fear often cause early exits or taking too little profit. A successful trader controls emotions and exits according to predefined rules. 5. Long-term perspective. Tharp says trading success doesn't come from one trade, but from organized and disciplined execution of many trades. Profit-taking and loss-limiting techniques ensure long-term profitability. 6. Benefits of a systematic plan. Every trade should have a pre-planned entry and exit. Trading according to a plan reduces risk and lowers psychological stress. Important message: the secret to trading success is not just the right entry, but the ability to secure profits and exit at the right time. A combination of stop-loss and profit-taking strategies makes your trading system safe and consistently profitable. At the end of the chapter, Tharp leaves a final thought. Have you ever thought how high your trading career could go if you could control both profit and loss in every trade? This thought makes readers and viewers realize that without proper entry and exit plans, long-term trading success is impossible. So friends, this was the complete summary of Van K. Tharp's Trade Your Way to Financial Freedom. If you apply these mental strategies, system-building techniques, and risk management principles in your trading, you too can take steps towards success and financial freedom in the market. If you enjoyed this video, don't forget to like, share, and subscribe. Tell us in the comments which trading strategy you will try first, and in the next video we will give more insights on that.